So my name is Christian Luper, and this is my investment strategy for Dr. Cresson, Finance 452, Spring 2015. For my strategy, I chose to compare P/E ratios, securities that have a high P/E ratio to securities that have a low P/E ratio, and see which one will give me the best return for the lowest amount of risk. Basically, a P/E ratio tells us how much investors are willing to pay per $1 of earnings on a security. So, for example, if you have a P/E ratio of 20, it simply means that investors are willing to pay $20 in order to earn $1 of earnings off of that security. If you look at a P/E ratio of 10, it means the same thing. It just means you're willing to pay $10 to earn $1 off of that security down the road. The formula for calculating P/E ratios is simply the market value per share divided by your earnings per share. This can be calculated two ways. You can use the earnings per share from the last 4 quarters, which is known as the trailing P/E ratio, or you can use estimated earnings for the next 4 quarters that haven't occurred yet, and this is known as the leading or projected P/E ratio. There really isn't a huge difference between these two strategies, but it is important to note that using the trailing P/E ratio will give you historically accurate data, which will lead to more precise results, whereas using the projected P/E ratio, you're pretty much having to go off of an analyst's predictions for what the company is going to be earning in the future, so it's not quite as accurate. Okay, so for high P/E ratios, it can mean that the market or industry average is expected to expand over the next few years. It can mean that the stock price is about to shoot through the roof due to higher earnings. A company with a high P/E ratio will eventually have to live up to that higher rating by substantially increasing their earnings or their stock price, or else they will eventually have to drop their stock price for people to buy it. A low P/E ratio doesn't really mean that the company is undervalued, and a low P/E ratio in general really isn't a bad thing, as you're about to see in my spreadsheet. But the lower P/E ratio could mean that the market believes the company is headed for trouble in the near future. Maybe their stock price is about to bottom out. It could also mean that they're going to have lower earnings than expected in the future. This wouldn't necessarily be reflected in the trailing P/E ratio strategy until earnings are actually released, during which time the company might look undervalued anyway. Okay, so this is my spreadsheet. Okay, so on the left I have my stocks with high P/E ratios, and all of these stocks are like social media type stocks, and then for my stocks with low P/E ratios, most of these are energy stocks. And as you can see, I compared it to the S&P 500 1 year's data dating back to January 2nd, 2014 to January 2nd, 2015. And as you can see, for the high P/E ratio stocks, the P value is at 0.439, which is much higher than the 0.05 to make it statistically correlated, whereas the low P/E ratios down here is 0.00017, which makes it very statistically correlated, statistically significant. And then when you go back to the data, I calculated the returns and the standard deviation for each. For the high P/E ratio, my average return was 0.08%, with a standard deviation of 5.69%. For the low P/E ratios, my average return was 0.64%, with an average standard deviation of 3.41%. So, in conclusion, the correlation for high P/E ratios was not statistically significant, whereas the correlation for low P/E ratios was statistically significant. And in my research, I found that low P/E ratio stocks yield a much higher return, almost twice as much with half the risk in this case, as your securities that have a higher P/E ratio. This places the low P/E ratio stocks along the efficient frontier of investments, which, as we learned in Dr. Cresson's class, you would never invest in any stocks below that line, which is where all the high P/E ratio stocks fell in this specific test. And that's the end of my presentation.